Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Drew Meredith, thanks for joining me on the show, mate.
Thank you. Good to see you again.
Yeah, as always. Likewise. So for those people who don't know, this is the first episode that you and I are airing in the Australian Investors Podcast channel. But for those people who do follow Rask or Wattle Partners more broadly, we've been doing this for quite a while, a couple of months now, right?
Yeah, since reporting season. What was that? Yeah. July?
Yeah, end of July maybe? Yeah. So we'll get into, for those of you who don't know who Drew is, he'll share a bit about himself in just a moment. But Drew is a financial advisor, has been in the industry for years. We work together, which is fantastic. We've been working together since about the beginning of the year, working in the Melbourne office. And Drew's going to take us through a bit about what he does and then talk to us about how he analyzes fund managers. As you'll hear as he goes through, Drew talks to about anywhere between 10 and 15 fund managers or investors probably a week, which is huge. So he's got a lot to add. But Drew, mate, you actually sent me through some of the info on you before you, created Wattle Partners and worked for the business. So why don't you take us through back to when you graduated uni and what you went on to do?
Yeah, thanks for having me again. I think like most people, you kind of fall into a career out of uni. You apply for all kinds of graduate programs. I ended up at one of the big banks. I won't talk about it, which bank it was. This is in 2005, I think, is when I took the first job. I've worked every day since for 15 years. So that's why I look tired sometimes. Went straight into a graduate program. Became evident. This is in the middle of, the things that were being talked about in the Royal Commission last year or the year before were all happening at the time in 2005 when I joined. So it's a commission-driven advice model. It was about distributing in-house product. Yes, there was strategic advice, but it was mainly about getting paid a commission and a trail commission for whatever products the client needed. There was always a product that fit. So I only lasted about 18 months there. Was unemployed for about 12 weeks, tried the CFA program, and then halfway through the first unit, I met Jamie, who's business partner for the last 15 years. It's Jamie Nemesis at Wattle Partners. He had just joined what's known as the first fee-for-service independent advisory firm in Australia. It was called Donnelly Wealth Management. It's had a few names over the years, as most businesses do. Yep. That was founded by Austin Donnelly, history dating back to something like 1973, and it was basically all about transparency and fee for service. He was interestingly a expert witness for people suing their financial advisors in the 80s and 90s.
So you left this big bank because you were kind of disgruntled with the way things were going, and then you thought this needs to be better?
Yeah, you're being pushed in different directions. So you're either becoming a salesperson or you're becoming a back office paraplanner. And there wasn't really the training you needed to be a real or a proper advisor at the time. And it just didn't feel comfortable. I think it was the main reason. I didn't know where I was going. I think it's the only time I've been unemployed since I finished school. It was great for a while. Interesting, I'm back in the same house now that as I was then. I own it this time, which is fine.
And so you worked at Donnelly Wealth Management, and Jamie was already there, was he?
Yeah, Jamie was there. He just bought about 50% of the company with who is now the chairman of Wattle Partners. So it's Ian Murdoch. And he was married to Austin Donnelly's daughter. That's kind of where all the connection comes in. Eventually he retired, the business was sold, and we started Wattle Partners with the same approach in 2010. So 10 years on our own.
Cool. And so I think this is a really important point, is that like the way you set up the business is really neat, right? Like we did hear a lot of in 2019, a lot of the stuff come out in the Royal Commission about how it's very easy, it's a slippery slope for financial advisors and how things can go wrong pretty quickly. And obviously you guys recognized pretty early on the way that was going, right? And set the business up accordingly.
It was kind of always set that way. So the Royal Commission and the FOFA and all the different legislation that came in over the last 10 years was basically bring everything into line with what Austin was doing in the 2000s. He was more an hourly, tick your hours in a book, which everyone knows is the most difficult way to run a business, because you end up spending more time counting how many hours you've done than actually helping people. Yep. So we're more on the fixed fee line, where we negotiate a retainer type agreement, and then you guarantee that out for a few years, so we can get on with business of managing people's financial affairs. So a lot of it was catching up. I think most things are good. So opting in, I think it's at the moment, it's still only every 2 years you need to opt in. But there are obviously, there's a lot of different advice needs, and with a lot of people leaving the industry, there's a big group of people that are lacking access to advice. And
that's the thing, right? Like we talk about this a lot. The way the industry has gone most recently, and there'll be so many people listening to this who understand and appreciate this, but there's this almost dichotomy between people who really need advice but can't afford it, and advisors who want to give advice but can't afford to give it because of regulation and because of all the changes that have happened. And so many advisors have left.
Yeah.
It's just made it so hard for people to access proper advice, right?
Yeah, I think there was in the industry publications this week, there was talk that the average cost of opening a client's file is about $3,500 a year. So including things like rent, insurance, all the different registrations we have to have. So it's probably accurate, but I think COVID, if anything's taught us to embrace technology, and once you embrace technology, you can easily advise a broader group of people. And I know the regulator's pretty keen on being able to provide more specific scaled advice, which means, providing advice on a single, comparing your super funds or how much you can contribute, rather than doing this comprehensive for every single person when they may not need it.
And that's the thing, like, so for the difference between your business and my business is we're general advice. So we don't give personal advice, and we focus on comparing, really. We do research, right?
Yeah.
And you guys can sit down with people, take that information as well as give them the advice they need. And where those lines meet in the middle is often pretty blurred from a regulatory perspective, but it's so important because at scale is pretty much the only way you can bring down, in my opinion, bring down the cost of good advice. Even if it's just general advice, it's really the only way to do it. Would you agree with that? Or?
Yeah, and it's kind of, for us, we're very high touch. So we do quarterly written reviews. We're constantly answering, it could be I'm buying a property tomorrow. Can you model what that impact that might have on my income? This is overnight requirements to do analysis of changing situations. And it's not cheap to deliver, but it's just part of. I kind of lost your question there.
No, but you're right. It is like, so I find this with people who give personal advice, is they often tend to have clients who are quite wealthy because they have to be that person they have to have someone on call effectively. Like I know you guys have clients all around Australia, and
you're talking about scale.
A lot of them are over 50, right? And you have to be able to do that. But if you're trying to deal with someone who might have $50,000 in investments and $70,000 in super, it's very hard to say, we'll be able to be on call for you. I know you guys have kind of like a mixed model, but maybe you could just tell us a bit more about like how your business is split. My understanding is it's kind of like split in two, how you operate as a financial planner.
Yep. I think what I was trying to get to before was that, the biggest number of clients we can probably deal with per advisor is 100. 100 clients for an individual advisor with a support team below us. So that's where your scale is kind of capped without using technology. And that 100 people, it actually allows you to know everything about them. When you call, you don't have to Google them and find out, or not Google, go through your CRM and remember everything about them. So now our business is split, so it's fairly typical. We're comprehensive. So on one side we do strategy, as you've said in the past, it's like the free kicks. Can you avoid mistakes? Are you making enough contributions? Do you have enough insurance? Do you have too much insurance? The only thing we don't do is margin lending, and credit and loans. It's just not something that we're skilled at. So everything on the strategic side, which is kind of a starting point, get all your structures, get all your superannuation, compare your super fund, all those sort of tasks. And then a lot of our clients join us for ongoing portfolio management. So on that, we build portfolios from the top down, which is what we're here to discuss, I think. Looking at starting at risk profiles, going down to asset allocation, and then going down to individual investments. And that includes exchange traded funds, managed funds, direct shares, whatever's appropriate for each person. That's kind of the difference between a Wattle Partners and a lot of other groups, where we can recommend whatever product is deemed appropriate, and we don't have any in-house products.
Yeah, and that's a big thing that came out again in the Royal Commission, was that I guess that alignment that people have and the associations that you almost always see in the FSG, the Financial Services Guide. So I know a lot of our listeners were keen to have some financial planning experts on the show. I think we had a survey recently, and around about, I think it was about 45% of people that took the survey said that they want to hear from a financial planner, and how people like yourself think about portfolio construction. Obviously, we've got, like you said, you've got the free kick side. So you've got like the financial, the actual, what people associate with financial planning, but then you've got the portfolio management, that ongoing consultation. I've heard you say before, and you said it just before, about 100 clients. I've heard people say that when they have teams, this is for aligned groups, I should say, in the past, that they've had 500 clients, which per advisor, which is just unbelievable to me.
Yeah, and you're probably looking at annual reviews in that case, where there's kind of a templated document that goes out to assess their situation. And we've always been, for 15 years, for better or worse, we do quarterly reviews, and that fits in with how we manage portfolios. We think you need structure around reviewing your asset allocation and reviewing what investments you're holding. And maybe it's just more for us that it forces us to review them more regularly. So it's, I think there's been averages of over 1,000 advisors as well. And the whole system of large financial institutions is kind of the products subsidizing the advice. So the advice doesn't make money, and they issue products to basically offset the cost. Yeah,
which is crazy, because that's what if we talk about the lower end of this, like the client base, in terms of, like, their financial, I guess I don't know what you call it, but just their ability to pay such high fees for a financial planner. But they don't have that ability, yet they're getting the advice, which is probably not ideal for them, which makes it so difficult at the same time. People often say to me, I'm pretty switched on, I understand investing, I do all this sort of stuff. Why would I need to pay a financial advisor? It's pretty expensive. Do you have that conversation a lot?
A lot. We have one single quote that we use. I can say what our average fee is, but it basically, for our fee, if we can stop you from making one mistake, that mistake could be on strategy. Over contributing to super is something that a lot of people do, and that can be extremely costly. If we can stop you from doing that, if you've got too much insurance and you're paying a commission that you shouldn't have, if we can stop you from one mistake or find you one investment idea, then our fee pays for itself every year. And as we've kind of discussed offline, some of the decisions we made this year have added, 4 or 5 times the cost of our fees for a lot of our clients. So,
because it's pretty hard for people to quantify that, because it's almost based on like the future, right? And unless they actually have the consultation with you, they're not going to know for sure what that is. And there's so many people I know in our community, in the Rask community, through this podcast, through many others, that there are so many of the listeners that are unadvised and probably could just take it, even just a half an hour rain check to see what's going on. or just a checkup, I should say, to see what's going on. It would make the world of difference. Are you happy to disclose your average fee, or is that something that you kind of keep as a?
I mean, we for non-friends, if that makes sense, we have a minimum fee that's about 10,000 a year. That's mainly for your retirees and 50 plus professionals, but we do have alternatives for younger people that are more focused around the investment side as well.
Yeah,
not just younger people, but
because you've got the like ETF, like model portfolios and that type of stuff as well, right?
Yeah. So we've got like a capped fee model on the ETF side, which would just cover investments and asset allocation, whereas the higher fee covers everything. So, when the budget gets announced, we're out to you the next week talking about what strategies you can implement, whether that's contributions or both include full service. We see it as three things. So one, we do three parts of advice: strategy, asset allocation, investments.
Yeah.
And our service offering differentiates by having all three or just the investment part.
Yeah. And it sounds like a lot of money, but for people, say like around my age, turning 30 next week, Drew, so go easy on me. It sounds like a lot of money for people that have a smaller portfolio, but for those that have a quite a large portfolio, like you said, that's basis. We're talking basis points, and errors are typically measured in hundreds of basis points when it comes to portfolio allocation and construction. So you almost reverse the risk there for the client. One of the things before we get into how you analyze fund managers and what you're looking for pretty much each week as you go about, thinking about that portfolio construction piece, is just on the financial planning scene and side of things. What are some of the challenges that financial planners are facing right now? Coming off the back of the Royal Commission, just in general, I guess, as you go about meeting with clients, what are some of the challenges that you face, and what can some of our listeners take away from them to try and educate themselves?
And the big one is fees, which we've discussed a little bit. And there's a comparison, fair or not, to large funds, corporate or industry, where they charge something like a 0.8%. But in most cases, you're not getting any strategic advice or support out of that. All you're getting is investment advice and maybe some, as we said, scaled advice. Can I contribute? How much can I contribute? But our fees, which include everything, and the ability to call us or text me at 11 o'clock at night, or and it happens more than you'd think. It just it doesn't even compare. I've calling in the middle of March was a perfect example where we were fielding calls about what to do. I need to sell everything. It's freaking out. Not that many people called, but you compare that to us facing the member or the client, whereas if you're at a large fund and you call, you get sent to an app, and the app lets you transfer to cash overnight. So being the face to the client, which I don't think many fund managers or many large corporate or any major funds really quite understand. And when you've got millions of members, you can't be in front of all of them. But when you've got 100, you know them, their kids, their their grandparents, their dogs. I've taken my dog to meetings before. So it's that being involved in everything in the fee discussion. And then on the investment side, it's income. People are just desperate to find income. We're to people who've got term deposits that are now offering 0.6% for 5 years. And so a lot of the role is about education, similar to what you're doing, and why we like what you're doing is, there's no point seeking income if you're giving up capital. So it's about educating people into why you're investing and why you're taking risk above cash and why you have to, basically.
I think that this is it's a unique kind of thing, because it's at those moments, and we'll get to why they're so important in just a minute when we talk about analyzing fund managers, is at those moments of uncertainty that you need that sounding board. And those are the moments when you're acting out of, I guess, emotion and not logic. And it's easier said than done. I see it all the time with investors who are really, really intelligent people, yet you get an instance like March 2020 when you have coronavirus and the market's crashing, and even these really smart people are making really poor decisions. And it's because they're They don't have that network, that person that they can go to. And I've often heard, Drew, that 90% of a financial advisor's job is just education. It's just educating the client on how to act and behave better and why strategies work. You and I are going to do this more regularly going forward, so I'm sure we can come back to this and talk about some of the challenges and opportunities in the industry as well. But one of the things that I wanted to get you on for was this discussion about how to analyze fund managers. As you know, I speak to a lot of fund managers, and you, with your podcast series, the Waddle Partners podcast series, you also speak to a lot of fund managers, and you're doing this for your day job. So maybe we can just take it from the top, how you start that process of analyzing a fund manager, the things you're looking for, and then we'll drill down into, I guess, how it comes to portfolio construction.
Yep. Yeah, I think probably can I do the step back and go why you use a fund manager and how they fit, and kind of even the asset allocation part, because we don't just go out and go, oh, we need an Australian equity manager. It starts, we've been running a business or running a portfolio for a while, so we have they call it a neutral setting. So whenever you're going to start investing, you need to determine what your objective return is. Are you trying to get 15% per annum? Are you trying to get a balanced return, which is more like CPI plus 4? So that's used to be 6%. CPI plus B3. Yeah. The average 10-year return is something like 6 or 7% for a balanced portfolio. And so we basically were working out what sort of risk we need to take for each type of client. A lot of clients are retired, and it's more around drawing down, so protecting as well as growing their capital. The younger clients and people who are still working, it can be more aggressive. So the starting point for us is always getting the asset allocation right. You've extensive, as you know, we won't go into the research process and the various inputs that go into building a strategic asset allocation. For this discussion, it's probably more about when you're adjusting that. So we've got a portfolio set at the moment. On a quarterly basis, we'd say, all right, where is our equity exposure compared to where we thought it should be last quarter? Should we be increasing that based on our discussions with economists, investment committee members, and all the different fund managers we meet every week? And then once you make a decision, we've got a few examples we can go through before. Are we underweight equities? Are we overweight equities? Are we overweight domestic or global equities? Should we be adjusting those? And it's once you identify the weightings and your views, are markets now overvalued? Should we be reducing our market exposure? Then you start thinking about what manager to add, or how to review a manager after that. If that wasn't too much blabbering on.
No. So I think most people don't think about what their neutral setting would be, right?
Yeah.
As well as I do, that academic theory is almost purely based on a 60-40 portfolio. We got 40% defensive assets, 60% growth assets, or like we tweak it. Most people think about it as bonds and stocks because that's the easiest for academic literature to be based on. But is that, like, just in loose terms, is that kind of what you think about? Like, it's those allocations to growth or risk off assets?
Broadly, yes, that's probably the most important. And as I said at the start, the two areas of investment is asset allocation and investment selection. Most people spend 90%, even a lot of advisors spend 90% of their time on the investment selection. I know Vanguard's got reports that say 90% of your returns come from asset allocation. In our research, 90% relies on asset allocation, but it's more about staying exposed to markets during that period. And the way you stay exposed to markets, like in March, the way you don't sell is if you've got a portion of capital that's safe in those periods. So you're going to be fine, and you can let the rest of it stay in the market. Because we saw there, if you sold in March and did nothing until now, you'd be 40% lower than what people who just stayed invested the whole period were.
Yeah, we talked about that during March, right? When we were in the office, we were talking about how some people were going all cash, and it was just madness. It was so easy to do in an app. And
even some Australian equity managers, the return differential is 30%. Some are down 10, and some are up 20.
Yeah, right.
Just over a 12-month period.
Yeah. Okay, so let's talk about, like, one of the words that I use is expression. I'm not the first to use this, so it's not like patented to me, by the way. But one of the words I use is expression. So if you have, let's call it a trade, and we're not talking about trading, but a trade that you want to get exposed to, how do you go about deciding what's the best expression of that and what's the best vehicle for getting that exposure? Like, if it's a low cost portfolio, what might you do there versus, say, if you're trying to get exposure to a niche market?
Yeah, so it's kind of the first step you take. If you think you're underweight Australian or domestic or global equities, how do you do it? I think the default in most cases should be an index or a low cost option, an ETF, the cheapest way you can do it. But then you need to consider if you're buying an ETF or an index in Australia at the moment, you're getting 50% in two sectors. So you're getting 30% financials and 18% materials. Is that really the best op? Is that where you want to be exposed at the moment? So that'd be our starting point for most sectors. If there's a good index, the S&P 500 or the NASDAQ or the Euro stocks, start there. If it is a good expression of the exposure you want, generally it's not, as you're kind of getting from this. We've done, in our view, that tends to work better when markets are cheap by historical standards. So you're more likely to use a passive or an index strategy when the ASX is at 4,000 points. Not saying it's going there.
Yeah.
Similarly, buying the S&P 500, you're getting 25% in 5 stocks at the moment. So it's, we start at the passive level, and then start identifying what sectors within which parts of the economy we want to be exposed to.
And that's where you might get that more active approach, like where you're looking for managers to fulfill a specific niche, or I guess if it's like risk off, like what kind of risk off exposure do you want? Is that what, am I thinking the right way there? Or?
Yeah, definitely. So when you talk about the asset allocation within your exposure to equities, you'll split that between global and domestic. There's always a tilt to home because you do get some franking credits and the tax and reporting benefits. But within that, you start looking at the market cap exposures within your portfolio. So do you just want large global tech companies? Do you need some mid cap overseas is actually large cap in Australia? Do you need some global small caps, which are mid cap in Australia? Do you need small caps in Australia? Where are the growth opportunities? Where are the value opportunities? And then the style comes through it as well. So it's looking into almost the minutiae of every asset class and comparing valuations across each one.
How do you, from a higher level, how do you think about valuations then from markets? Are you using things like the CAPE ratio? Are you listening to economists, or how do you get that information?
A bit of everything. Everyone wishes there was a single rule. The CAPE ratio has its own issues, as you know.
For sure.
It's it was a survivorship bias, and there's a lot of other things that come into it. And like the example here is CSL's trades on a massive PE, so it drags the whole PE of the market up, but you exclude CSL out, and it's a very different ball game. So
and then how about like in terms of like overseas markets? Do you engage with economists, or do you just more like, do you use different sources of information to piece that puzzle together?
Everything. So we've got multiple research houses that we use. We've got access to, so the benefit of most managers is the managers we use as well as managers we don't use is they're incredibly open with their information and their views. White papers, webinars, and particularly these days, you can get the chief economist of a massive investment bank not on a Zoom call, but you can get the views of everyone quite easily these days. So it's just inputting everything and relying on a diverse group of resources and resources you trust as well.
Yeah, for sure. So,
and having some external views on your investment committee is always important.
So how about then, like, let's just describe the week for you, because people don't know this about you unless they're your client. I walked in on you one day and you had this huge Microsoft Word document in front of you, and I was thinking, what the heck is he doing? And it was this quarterly review that you do.
Yep.
It looked like it was about 100 pages of different research on different like products and companies and what have you. How do you structure your week? Do you meet with a lot of fundies each week?
Yeah, I wish I could structure it better.
Don't we all?
And fit it all into one day. Yeah, we're probably meeting 10 to 15, not just managers, but economists, other experts, industry experts from other industries. You know, we're privy to some of, as you'd see, the IPOs and the broker presentations. So it's kind of all over the place. Plus, we read a lot. You see I treat my inbox as a reading list, and I try to finish that off on the weekends. So it's constantly meeting people, getting different views, challenging views, and as you go through our sessions, all the managers of the funds that we use are incredibly open, and they're willing to answer the most difficult questions. There's no hiding at all anymore. So you can really understand, and that's one of our requirements with a fund manager, is being transparent and accessible. You know, we could call everyone in March that we had engaged, and they'd answer and tell us the questions, or answer the questions we had.
Which is so important. I think sometimes you've just got to look people in the eye, right, to get a sense of who they are.
Yeah.
And I'm probably not as structured as you, but when I think about managers and I think about funds, I'm very privileged in that I get to speak to a lot of great fund managers. I know a lot of people aren't, so that's where the webinars and that type of thing come in. But you are too, like walking into our
got
office.
To speak to Hamish Douglas though. You'll have to. You're ahead of me on that one.
You got Gerald Stack on the show.
Yeah,
so,
Gerald. He's Hamish's boss on the investment committee, isn't he?
Yeah, something like that. Yeah, so perfect. But we are very privileged with that, right? So it's not, we're very lucky. And I think my time spent as a very short time, I should add, spent as a funds research analyst. It highlighted to me the value from being in the room with managers is superb. It's hard to put into words because you get so much from that conversation that go well beyond just the fund that you're looking at. You get to insights into their research process, you get to see their models and how they think. And I think that's a really important insight you can't get unless you're constantly doing it.
And you do get different information to what an end investor would get.
Oh, totally. Yeah, they're much more candid.
So you're not just getting a monthly report. We're getting white papers. I can't even count how many white papers and my whole week could be full of webinars and white papers, and the amount of information they're willing to provide, and the amount of managers are also willing to provide good ones, are support to our investment decisions. So if they want to pitch if they think their fund should replace something else in our portfolio, they'll compare all of their holdings against holdings of their competitors and their performance and their attribution, and these are all things we'll go on to later.
Yeah. Let's talk about that then. So let's through the process, your investment process, and I guess your client process, if you will, we've moved from sorting out their financial affairs, that side of things. Now we've moved through strategic allocation, which might be based on risk profile, appetite, time horizon, all those different wonderful things that we talk about in financial planning. But then the next step is choosing the right manager for that portfolio. So how do you go about doing that? And how do you go about, what are some of the, I guess just from a high level, some of the things that you think about before you make a decision to add a manager?
So I've got, as you expect, we've got extensive questionnaires and information. There's a good tool. Some managers release it, which is, I think it's called the Financial Services Questionnaire.
Yeah, right. I've never heard that.
If they want to be, I think if they want to be approved as a manager, it's a 50-page questionnaire. They have to detail their investment philosophy.
Oh, right. I have seen it actually. Yeah.
It's more the compliance document, which is actually, when they have to be succinct, you get rid of all the fluff and the PowerPoint slides that come with it. We probably have 20 criteria, but I think we've kind of kind of shrunk it down to 5 because we could talk for another 6 hours otherwise.
Yeah.
Ultimately, you're looking for after fee returns that are beating the benchmark. That's what we're all looking for.
Yeah.
And we say after fees because there's always a question about, is an active manager another whole discussion. 70% of active managers outperform. I also question that statistic, the generalization. But you take fees out of the equation by assessing performance after fees against benchmarks. And yes, performance is, past performance, no guarantee of future performance, but it's a pretty good indicator that someone, particularly in this environment, has dealt with a crisis. How they've dealt with crises, have they outperformed during those periods, is incredibly important.
How do you think about, speaking of fees, how do you think about performance fees? There are two camps on this. There is one camp that says there should never be a performance fee because it means you're paying them to do their job, like you're paying them more to do their job. But then there's the other camp that says, well, we should be incentivizing them to do better because that's a good outcome for us. Where do you see that?
I'm on the more performance fees, the better. The more it's expanded, the better. As long as that is reducing the base fee. I think it's where the institutional world's going, where your base fee gets lower and lower, but you're being paid a performance fee. But for us, that performance fee has to be based on not just benchmark outperformance, but absolute returns. There's no point. Why should you get paid for falling 20% if the market fell 30? You've still lost 20% of that capital. That's not our performance. So making sure they're adjusted appropriately. And most most funds are now offering a full fee. So I think Platinum was one example where it's 1.3 or a lower fee plus performance. And that kind of comes to alignment, which we see as important when picking a manager. So is the other decision makers investing in the fund? You always want to make sure that their wealth is invested in a substantial amount. Particularly in some cases, and their bonuses and their performance targets are going back into the fund, not just yours.
So do you just ask them that?
Most be very open. If they're not open, then generally they're not investing it in there. I mean, when it's a startup manager, then it's more likely that they are putting everything in there. If they're not attached to a big institution. So with institutions, you just want to make sure that there's still alignment.
So how about then again on a performance fee? I'm guessing you're looking for high watermarks. So performance has to return to the level that it was previously. How about then managers who benchmark against fixed benchmarks? So say like I don't know, like a 5%
Cash
hurdle,
plus.
or 10% hurdle or something, or cash plus. Something like cash plus. What do you think about those?
I think they're all right in certain situations.
So would you be comfortable if an equity manager, for example, had a 8% fixed fee absolute return?
Ultimately, I prefer if it was almost a benchmark plus, but then it's kind of you don't want to pull all of their fees away from their business if they can't make a decision. For instance, if you're a long only equity and you can't move your cash greater than 10%, well, there's only so much you can do in terms of protecting your portfolio. So it's being wary of that part as well.
How about then, say, like absolute return funds that are like RBA cash rate kind of thing? What do you think about those?
Plus a bit more is what I prefer.
That's always something that struck me as kind of unusual, is that yes, you're an absolute return, but you do invest in risk on assets, so you should have
a real hurdle.
We see this more often, that people say, oh, the management fee is pretty low. However, we take a performance fee, but the management fee being low doesn't really mean much if the benchmark for the performance fee is also so low. Because then it's just put it in a cash plus fund or like a cash enhanced fund, and you probably make a performance fee.
And they've got their own pressures as well. So a lot of the institutional investors that go into these funds will get different fee arrangements to what we and direct investors get, where it's more performance, where they want it as low as possible and they don't get the base fee. So it's kind of, it's always, you got to be shrewd. And
you bring up a good point there, Drew, which is sometimes, and I know that, like, for example, like you guys might be able to do this too, is when a fundie comes to you and says, hey, this is our fund, come on, we can do this for your clients and blah, blah, blah. Do you have bargaining power with them?
Sometimes.
Yeah.
Yeah. So we can, in quite a few occasions, we've negotiated discounts to management fees.
Yeah.
I won't say which ones.
Yeah. But it's
only clients will know that. Obviously, they don't want other people to know either.
Yeah.
And I mean, it's actually more work for us because when your fees are rebated in the form of extra units in the fund, we have to enter that onto our system every month. So it's actually a lot of an administrative burden, but there is some negotiating power, definitely.
Yeah, and because you hear this, right? I heard some extreme examples this week of some I won't name names, but investment managers who have been approached by big pension funds to say, yeah, we'll give you $1 billion to manage, but it's going to be 1 basis point.
Yeah.
That's an extreme example, but it does happen quite a bit. And for retail investors, they don't often understand that because they don't have the leverage. They can't say, I've got 50 grand. What can you do for me? Mr. Manager with, $2 billion under management. So it's a totally different, I guess, bargaining position.
Particularly with newer managers. As well, but obviously the more assets you have, the better. I'm writing an article on probably the same fund manager you're talking about at the moment.
So how about then, there's one thing that I learned from you recently when we were just talking offhand, which was this idea that when you rebalance, the actual when is really important. So it's not just about, this is strategic asset allocation, equities have hit this part of this much in the portfolio, let's rebalance. It's actually when you make that decision is actually crucial. And March, I think, was a really good example of that. So maybe can you talk us through when is the best time to make strategic changes or tactical changes?
The best time is the hardest time. And that's probably where our value has been shown best in the last few years, is that when markets are crashing or running, is actually the best time to rebalance. It's been the most powerful. Right. It's a very nervous period.
Yeah.
I was waking up and seeing the S&P had fallen 7% overnight, and then working out what I was going to do that day. But if you can rebalance, so for instance, I bought 2 examples, or I have 2 examples from March, April, that we did. One during March, so we went outside of our quarterly period and said we should do this, and then in April as part of our quarterly period, so we did 2 stages. We saw that equity markets had fallen 25%, so our equity exposure was very low. We have a reasonable allocation to alternative assets, another discussion there, that held their value or went up. So we made a decision that we needed to increase our equity exposure, and there's other inputs into that, not necessarily a vaccine, but that the market sell-off was completely overdone to what was actually occurring.
Totally.
So we moved 5% of the portfolios from alternative assets into equities, very close to the bottom of the market. And that, as we said before, if you were selling equities, you just capitalized a 30% loss in 4 weeks. If you were buying equities, well, you've just picked up a 40% gain in 6 weeks. So it's as difficult as it is. The quarterly period helps. We try not to be stuck on the quarterly. We're still doing investment committee and reviewing asset allocation at least monthly, and stocks almost daily. But just having structure and being willing to make a major decision during difficult periods, and that's where the objectivity of me managing someone else's money versus managing your own money makes it a bit easier. The amount of positive feedback we got from clients that said, I'm happy you've been trying to protect our portfolio during this period. This is great advice. I wouldn't be doing it. Couldn't stomach doing it myself. Just kind of being a step back, even though my parents are one of my clients as well. So there's, yeah.
How about then, so let's say you're not someone who's advised. What are some of the things that people could do, I guess, just to think that way and try and move themselves towards that? Do you think having the structure of quarterly rebalancing is essential for everyone, regardless of whether you've got an advisor or not?
I think you should at least be doing it every 6 months. Set an hour apart, download some asset allocation reports. There's a lot you can get. Morningstar, as we said, is one example that has a personal investor product as well. We think the first thing we do for every new client is we build an investment policy document, which sets out asset allocation, rebalancing, when we buy and sell, if equities are 5% below the target, then we want to increase them, and kind of those rules.
Yep.
And then we give every client that on a single page, which I think everyone can easily do. You can Google, I think Vanguard has one as well. You Google investment policy document, pension funds run with them, corporate super funds run with them. That's just a simple thing. If you died tomorrow, someone could pick up your portfolio and hopefully understand what you're doing.
Yeah.
And then just having some structure.
And that's a big thing, like you're a certified financial planner, right?
Yep.
Yeah, CFP. And you see that in the CFA programs as well. It's such an important part of the process. People kind of write it off because it's not always the most technical, but it's actually probably one of the most important parts of just your own investment process as well, right?
It should be the first thing. So every trustee board of a super fund would pull out their investment policy at every board meeting, and that's what they refer to. And if you think it needs to change, you change your policy, and then you change your investments feeding into it. And it's just discipline. Maybe I'm just one of those kind of regimented people where I like structure, discipline, consistency. And I think you need that for investing.
I think in the US, particularly, we're seeing more of this is the robo-advice market, servicing that lower end of the market. They're starting to do this more often. So they have an investment policy statement, but then they also have kind of like feedback loops for the user, as opposed to a user in that product or in that service to question their decisions. Like, don't click this button unless you've checked this.
Yeah.
And that's kind of a low-cost way to fill that need. But I think everyone can do this to an extent, right? But if you do find yourself getting a bit tangled up in everything, go and see someone. Let's get back on the topic of fund managers. What are some of the questions you would ask a fund manager? Do you have any kind of examples that you can give us from your, you mentioned before you have quite a few, but are there any examples that come to mind?
I'll probably go examples on what they've been doing. So we talked about attribution. One of the best ideas there is the active share. If I'm sure you know that stat.
Maybe you can explain it for
measure.
us, just for those people that don't understand it.
Yeah, so active share is a percentage, and basically the percentage of stocks that company or that fund manager holds that are different from its underlying index. So if it's a US large cap strategy and its active share is 95%, that means 95% of the stocks are different to what's in the S&P 500. So if we're making the decision to employ an active manager, well, we don't want to pay active fees for someone that's doing an index, giving us an index. So if you've got a low active share, honestly, then you may as well buy the ETF in that case. And part of that active share talks about attribution. So where are the returns for that fund coming from? Are they doing what they're saying is, are they a value manager? All right. Is a value manager holding tech stocks? There's kind of this overlap that all the factors, we can talk about that too, fall into are kind of falling into the same funds. There's a lot of value managers that are holding growth stocks, and there's a lot of growth managers holding value stocks. So asking the questions that and confirming where the performance of that fund is coming from. Is it coming from what they're actually saying?
This is the thing though, right? Like a lot of DIY investors, they don't have access to attribution. So attribution is something that we use a lot in advice land, but also in research land. We talk about, so yeah, it's good. You can see the top 10 holdings in a monthly or whatever. But attribution, for those people who don't understand it, it actually looks through the portfolio. So I think there are certain financial providers and data providers that say that, we provide this look through and we'll give it a fancy name and whatever.
Yeah.
How do you get that attribution on returns?
We've got our own systems. We've got a couple of systems. One's Xplan, Iris, the biggest tech company in Australia, which does a portion. And then we use a couple of research providers. And then interestingly, most managers who use the same software as us will input our portfolio and compare their strategy they'd like us to invest into. And give us the attribution. So it talks about how many basis points did this individual stock holding add to performance over a period, how many detracted. And you quickly see if 40% of the returns are coming from 4 stocks. It's a lot of look through from a simple report.
Yeah, and this is something that is really interesting because to be honest with you, Drew, like I know from a financial planning perspective that growth versus value is a conscious choice that advisors make. From a personal investor perspective, I'm kind of like looking for absolute returns. And I know there are certain times when value is better than growth and whatever. But when it comes to attribution, you can also do factor analysis based on what they send you. You can look at geographies. If they're a global fund, where are they getting their, most of their alpha? If they're, if you compare it to the factor models, are they using small caps? Are they using, low PE stocks?
Yeah.
That's really insightful, right?
Yeah, they're actually really easy for us to get. Everyone is willing to give them to us, and we're able to analyze them ourselves as well, which you don't get factor in a monthly report or a quarterly report. You get a couple of stock highlights and what the top 10 stocks are. But there's so many tools. You can almost paralysis by analysis can be an issue sometimes. But you're just understanding, are they doing what they're saying? And that a big part of that is a question of, if they underperformed in the past, have they changed their approach? Is a growth manager that underperformed now becoming a value manager because value is doing better? These are the kind of reasons you'd remove or you'd watch for in a manager that you're employing.
Yeah, we see that. You see that style drift quite often.
Yeah,
I don't mind it when a manager is explicit about it. Like, hey, we've invested this way for a long time, but we think this is a structural shift. I'm going to be honest with you. This is what we're doing.
Yeah.
But it's when they don't say anything and they've all of a sudden gone from owning,
no tech to all tech.
Yeah, no tech, all tech. Yeah, something like that. And they're not being honest with you. That's where I get a bit frustrated, and I'd be more inclined to question that. How about then when it comes to the resourcing of a fund manager? So a lot of people probably don't think about this, but I know you guys do. You think about it a lot, which is, a lot of these smaller boutique funds, they can be one-man bands or two-man bands or two people bands. We shouldn't be, it's not all men these days. So it's sometimes you have very small shops, so to speak. So how do you think about that, the resourcing angle?
Yeah, I mean, it's a difficult question because you do get great returns, and some of our best performances come from startup managers. I think there is a bit of almost flooding in the market. You have to understand that for most managers, I think you need something like 150 million under management to be cash flow break even. And not that there's anything bad. If a fund manager shuts, this is the other benefit of a managed fund over a listed investment company. If they aren't cash flow break even and they shut down, well, you can get your money back because it's just invested into stocks. If that was potentially an LIC and the manager shut down and someone else took over, then you might be selling at a discount. Probably one of the differences there. But you just have to ask all kinds of questions. How funded are they? What are their expenses? And a big part of that is, do they have if you're a global equity manager based in Australia, do you have the resources if you're not making money to outperform Magellan? Not pushing Magellan or anything. It's all, there's the businesses too. They get into it because they want to be more aligned with their investors. So what level of assets do they need to be break even? What level of assets do they need to add new analysts? Because it's great to have one investment decision maker, but as we all know, you don't want to be reliant on a single person. The big groups have done it well, bringing younger people up and spreading the decision making in different portfolios. And one of the issues there is, will they spend more time selling their product than they will analysing? Yeah, that's the biggest risk in the early days. I think you have some comfort around when someone's got an extensive background and track record in that specific strategy, that they will keep, that they know it, and particularly if their ex-employer has kind of signed off on what they've done.
It's one of those things, right? Most new funds, unless they do come out of a big shop and they have the support of a distribution partner, which we see probably more of these days.
Yeah,
it's more the distribution. The person that controls the distribution goes and has control and goes to Macquarie or goes to one of these big shops and says, "Hey, you guys look like you're good investors. Why don't you come over here? We'll give you a fund. We'll take an equity stake, and or we'll do all the distribution for you. No worries." Unless you're like that, the other side is the boutique fund who tries to go go at it by themselves. And they tend to keep their head in the sand for a while until they've got that track record, because they know no one's probably going to look at it.
Yeah.
And
it's kind of, it's kind of the fiduciary obligation that a financial advisor has as well. We're probably more comfortable backing a new manager that's associated with a $500 billion, fund manager, because they've got the resources, they've got, if you're doing global equities, you've got access to all the research from all the biggest players. So you do have some sort of competitive advantage.
Yep.
So it's resourcing like any business.
And then I guess you also, just on that, you also want to meet with people, right? Like it's just like anything, you got to know what you're invested in. So I imagine that you don't invest with someone unless you speak to them. Is that fair?
Yeah, we got 3 rules. I think it's 3. I mean, there's multiple. 3 rules. We have to have access, so we have to be able to meet the PM, the portfolio manager.
Yeah.
No offense, not the juniors. They might make all the decisions, but we want to meet the portfolio manager. We want to see the real portfolio, all the holdings.
Yeah.
Usually that's non-disclosure or confidentiality, and all those sort of things. And kind of standard is fees, making sure the fees are competitive as well.
Yeah. How about then, just kind of like, I know this conversation has gone on forever and we'll probably come back to it many, many times, but then what about like kind of this last piece, which is around risk management? So it's funny because when you get these, when you get these research documents and these policy documents, oftentimes the risk management is just a couple of paragraphs. How do you think about risk management, and how do you judge a fund manager's ability to protect capital? Tough question.
Yeah. I mean, it depends on the strategy. So a long short manager versus a long only, which means one can take short positions and kind of hopefully protect the portfolio by doing that. You have to assess them differently. If it's long short, do they use their short positions prior to crises? And good ones have. And you can see the performance for some of them. The other ones are, one, do they have rules in place? So you have to ask them things like, do you apply stop losses? Can you increase your cash balance? What specific rules do you have? How big can your biggest holding be? What are your sector exposures? Because you can, control your downside by not being overweight. For instance, the banking sector in Australia that's down 30% represents 30% of the index. So you can outperform and you can not lose capital by having sector weightings. And do they actually stick to them? So when you see the portfolio and they say that they only have 2 holdings per sector, but they've got 4, or there's kind of, what do they call it? Sector drift, or so just one, asking those the deeper questions, and that you don't have to use stop losses, but if you say you use them, prove that you do.
And I think, and another one is with on that long short piece is, you can get authorizations to have a fund that allows you to go long and short, but do you actually use them? And the second piece is it purely for risk management, or are your short positions for alpha as well?
Yeah, and do you have experience shorting? I mean, shorting is a very different game to buying a stock and watching the earnings. You can lose more than 100% shorting.
And you can lose it quickly, right?
Yeah, exactly. So you can't there's a lot of people that pop up with a long short strategy that don't have the experience on the short side, which is very different.
Because this is the catch-22 of having all these the different mandates and restrictions from a risk management perspective. It's good because you can sell, because you can go to a planning group and say, we only have this amount of weightings in this sector and blah, 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 blah. But at the same time, if they are a good investor, you want to give them the freedom to invest well. So it's a bit of give and take, and you have to, that's where I feel like eyeballing the fund manager is really important. You have to understand their thought process as much as what they've written on the marketing document.
Yeah.
Cool, mate. I'm cognizant that we originally said we'd keep this to 30 minutes.
Now it's an hour, isn't it?
It's talk about style drift. We've gone on for a bit, but I know that you're producing one interview a week or thereabouts. And now the podcast, the Wattle Partners podcast, is on iTunes. That's great. Well done.
It was exciting.
But it's because you're meeting with all these fund managers anyway, so may as well record them, right? And so
Yeah.
it's not just for clients. Anyone can go and listen.
Yeah.
So I'll put some links in the show notes for folks. And you'll be back. We're going to try and do these things every fortnight or every so often, so we can touch base and talk about more than just financial planning, because your remit goes well beyond that. But Drew, mate, from Wattle Partners, thanks for taking the time to join me on the show.
Thanks again.